Asian stocks were firm while the dollar remained on the back foot amid lower U.S. Treasury yields after benign consumer inflation data overnight reinforced bets for the Federal Reserve to start cutting interest rates next month. The dollar remained weak after slumping overnight to its lowest level to the euro since the end of last year. Traders remain convinced that the Fed will reduce rates on September 18th for the first time in 4.5 years, but are split on whether policymakers will opt for a supersized 50 basis point reduction. A major macroeconomic test looms later with the release of U.S. retail sales figures. Locally, Exxaro, South Africa's largest coal miner, reported that its coal production and sales for the interim period was down 13% and 12% respectively compared with the previous 6 months as a result of lower demand from Eskom and logistical challenges. Looking at the all-share index at this particular point, the all-share is about up 0.4%. Financials in leading territory up 1.4%. Resources up 1%. That is, industrials up about 0.25%, and the rand trading at 18.02 to the dollar, 19.84 to the euro, and 23 rand 15 to the pound. To give us his perspective on the markets, we are joined by Ricardo Smith, who's the Chief Investment Officer at ABSA Investments. Ricardo, thank you so much for your time. What do you make of market sentiment right now? Because we got the CPI figure. It is more in line in terms of what we were looking for, but is this enough?
Yeah, no, that print, came out. It was slightly lower than markets had penciled in. And it is a positive surprise, and we've seen the previous print also coming in quite positive. We've also seen PCE, which is the Fed's preferred measure, also coming in below 3% in producer price inflation. So there's certainly a positive indication that inflation is being contained, particularly looking at energy prices, food prices and goods prices. One sticky element remains services inflation. And on the other side of that coin, we have seen the labor market coming in a bit softer. Unemployment rate, has been ticking up for the past 4 prints in the U.S., with the latest coming in at 4.3%. So also, some positivity there, speaking to some potential rate cut in September. GDP numbers have been a bit stronger than anticipated. The U.S. market and spending has been a bit more resilient than what markets had penciled in, but certainly cooling inflation, rising unemployment does start to speak to a Fed cut in September.
Let's talk about that Fed cut, because I hear some saying 25 basis points. Some saying, OK, let's wait for 2 more data prints and perhaps we'll see 50 basis points. If we do get 50, what kind of signal does that send to the market, and what are the implications thereof for markets and the dot plot then?
Yeah, so 50 would be a bit aggressive. Of course, on the other side of that coin, when they were hiking, we did see front loading. There was a bit of pressure. Inflation was out of control. At the moment, from an economic perspective and an unemployment perspective, although trending in the direction of a cut, there isn't a lot out of control at this point in time, and so likely to see a gradual a cut, and seeing a bit of dipping the toe a bit before seeing further cuts. 50, would be induced by some concerns if unemployment continues to deteriorate faster than anticipated, and if the economy starts slowing down faster than the Fed would like to see. So there would be concerns around that. From a market perspective, any rate cut is a positive, as there's an inverse relationship with asset prices, and we are potentially starting to see some consumer pressure. And so rate cuts will be welcomed, whether it's 25 or 50, but certainly the anticipation is 25.
So on SENS this morning, we got results out of Exxaro and Standard Bank. But let's talk about Exxaro for a bit. That share price now down 2.5%. What stood out for you when you look at those numbers?
Certainly a bit of pressure from coal production, not a lot of demand from Eskom coming from the first quarter in particular. Although, recently we have seen steady supply of energy, and so that may begin to start to filter through to the numbers going forward. But from a general economic perspective, there isn't a strong demand for energy. We have seen slowdown in the Chinese economy, particularly the property sector, which is a large demander for commodities. And so some of our local intensive energy sectors in mining and in exporting, not demanding a lot of energy from Eskom and from the grid at this point. So it is a softer economy. And so markets responding quite negatively to that. And there is heavy reliance on coal. And, from our perspective, we have typically preferred some of your more diversified miners to avoid this single commodity risk space that, for instance, Exxaro finds itself.
I want to talk about U.S. earnings season, and it's been quite interesting to get the analysts' take in terms of what we've learned about corporate America. I've gotten different points of view, but I'm curious from your perspective, have we learned anything new or surprising that could lead us into what we can expect going forward for the rest of the year?
Yeah, I think the one thing is, despite some positive surprises in earnings growth, and, we've seen about 80% of the counters are surprising positively, we haven't really seen the rallies in equity markets in the U.S. And that's quite indicative of a couple of factors. And one is the strong valuations and asymmetric response to positive and negative news. We've seen a bit of volatility despite this resilience in earnings. Costs have been pushed forward, so there is a bit of a concern around guidance going forward and expenditure items that may come ahead. And we've seen a lot of disproportionate negative responses to a lot of negative news, including, a couple of weeks ago, we saw the yen a dollar trade playing out quite negatively. We've seen a lot of profit taking as well, particularly with this heightened level of concentration in the market. And, China, yet again, particularly on the consumer side, impacting a lot of the luxury goods sectors, which not one immediately thinks of, but certainly having an impact there. So news right now are fully loaded, prices are fully loaded, and so negative sentiments are being negatively responded to. And so that's a concerning space for markets. But certainly if we start to see rate cuts, we start to see a bit of easing in the system, that may allow some revaluations upwards for some of the counters in the US.
Ricardo, thank you so much for your time this afternoon. That is Ricardo Smith, who's the Chief Investment Officer at ABSA Investments, giving us his take on the latest market dynamics.